Increasing lifetime value through better monetization is the key to growing your subscription revenue. Too many subscription businesses focus only on retention. They're not thinking about pricing. They're not thinking about upsells. They're not thinking about the tiers that they have for their different subscriber levels in order to grow the average lifetime value. And instead, they're crippled with only one way in order to manage lifetime revenue growth for their subscription business. Today on Be Unleavable Subscription Growth, we're going to dive into monetization, pricing, and having lifetime value by subscription tiers by looking at a $3 billion subscription example. That and more on Be Unleavable Subscription Growth. Hi, I'm Robert Skrob. Welcome to Be Unleavable Subscription Growth. We're going to do a deep dive today into lifetime value and also tiered pricing and also cross-sells, upsells, so that we can really talk about this whole topic of lifetime value. It is what I see as really one of the key problems within the subscription business today. So many subscription businesses focus only on retention, and while retention is a key driver of lifetime value, it is only one piece of it. There's also pricing, monetization, and those are the things that we're going to talk about a lot today. The reason why it's so important is that so many subscription businesses, they try to grow, but they don't generate enough revenue from their subscribers in order to pay a customer acquisition cost. And what happens is they get caught in this trap where their subscribers are churning, but they don't have enough revenue to invest in the marketing in order to acquire new subscribers to replace the ones that are quitting. And they certainly don't have enough revenue to grow because they're losing members, and at the same time they can't get enough subscribers to they just get trapped. And so what we're going to talk about is how, in addition to retention, how you can also use pricing as well as monetization in order to continue to grow your subscription revenue. So first things first, let's dive into a quick example, give you a quick formula to kind of give you an idea of what we're going to be looking at here. Is average lifetime value for your subscriber is total revenue. You can calculate that by taking your total revenue and dividing it by your number of buyers, number of subscribers, and that gives you your average lifetime value. The key problem that a lot of subscription businesses, or the mistake that a lot of subscription businesses make, is they calculate a lifetime value. Say the lifetime value of a subscriber is $895. And they work to try to manage that average. And they go, okay, we're going to make it $1,000. And the problem is that you aren't really breaking apart the problem into its component points. Simply an average and trying to move an average is challenging because there's so many different types of customers of different values within the average. It's crucial that instead you go deeper than the average and manage that. So that's what we're going to do here today. So this is actually a chart that is out of this book that I co-authored with Perry Marshall, Detox, Declutter, and Dominate. And this is an example that, Perry Marshall is famous, and one of his greatest books, and probably one of the greatest books on marketing, is Perry Marshall's 80-20 Sales and Marketing book. And he talks a lot about the 80-20 principle and how that applies to businesses. And taking a look at the 80-20 principle here, you can see how it can be applied in this case to the Fortune 500 companies. And you can, here in number one, you can estimate the curve of the Fortune 500 by looking at any of the companies, but in this case, number 167, which at the time was Southwest Airlines with a revenue of $15.7 billion. You could use that company to create the black curve, which is an 80-20 curve that kind of extrapolates what the whole Fortune 500 would be. Then the blue line is actually the actual Fortune 500, and you can see now the shaded area right at 100. That helps illustrate that the top 100 companies of the Fortune 500 are generating 80% of the revenue of the entire Fortune 500. It's just these few companies generate the 80% of the revenue because so many of those companies go all the way to the top of the chart. And you've got a large number of companies, the bottom 400, that represents 80% of the companies, but only 20% of the revenue. And when we dive into your subscription numbers, you'll see that you are actually generating, when you're doing this right, you will be, when you're monetizing and managing your lifetime value, you'll have 20% of your customers that are generating 80% of the revenue. But yet when you manage simply only by the average lifetime value, what happens is you're only managing this bottom tier and you're not also growing the top higher. And so you aren't able to expand your revenue as fast as if you were managing each of those groups in turn. So let me dive into a company, their investor deck, that gives you some insight into how the company is operating and be able to kind of do an example on live data so that you can kind of see how all this works in action. And this is from the deck of Beacon Street Group. This is a company that is going public via a SPAC. And these are the brands that this company represents: Stansberry Research, Legacy, Altimetry. And in fact, this is all public information, so I'm not disclosing anything that the company hasn't already put on their investor deck. But I think that it's interesting that this chart is in the deck because I have never seen anything like this within a public company before. This is usually some of the great strategy work that I work with the marketers, with the CMO, with the CFO, in order to stratify different customers. And it was huge that a company published this so that we can use this as an example and that we can learn from what they're doing and how they're managing the different tiers of their customers. So let's dive into this. So at first here at the top, you have their free level. They have 9.5 million subscribers that invest in their free newsletters. So just as a little bit of background, Beacon Street Group is a company that publishes financial newsletters. They also have a number of SaaS products that they also sell. Several different types of subscriptions. Some of them are free, and as you'll see, some of them are higher priced. And so they have 9.5 million subscribers of their free publications, and they have listed 4 here as a kind of examples. Newswire, Investor Hour, the Weekly Pulse, and the Daily Cut. And so that they have a cumulative spend of 0 because they have spent nothing. Next, they are considering their paid subscribers, the individuals who are at the bottom tier, and valuing this group as less than $600. They are Fry's Investment Report at $249, Empire Stock Investor. These are annual subscriptions that their subscribers could benefit from. And with these 544,000 customers, these have spent less than $600. And then the next tier you see are the high value subscribers, and they have there's 215,000 that have spent between $600 and $5,000, and they are you can see that they've got Palm Beach Ventures, which is a $3,000 product, and Empire Elite Growth, which is a $5,000 product. And then beyond that, they've got 98,000 customers that have spent more than $5,000. And there's $31,000 products, and then there's $499 and $15,000. So these are much higher monetization rates than you very often see in other subscription businesses. And this of course are publishers that are able to publish materials, but you could still, there are examples of companies that have done this in SaaS. There are companies that have done this in other access. And so it's important that you're looking at monetization as a subscription business, not simply only looking at, maybe you're a subscription box and you're looking at other subscription boxes. Well, if you are following what other subscription boxes are doing, you're going to be paralyzed and trapped in the same way that other subscription boxes are. But instead, let's look at other subscription examples and see how they are managing them, and then how that informs what you do. So let's go to the next example, which is now, how does this apply to you? What do you do to use this to apply? But you kind of see that the higher tier, if you do the math, you'll see that these subscribers, in the high value and ultra high value, even though they represent, only 20% of the subscribers, roughly, because we're looking, of course, in this example, we're looking at a subscription business that has a lot of different brands, and then also the kind of if we look at the actual average, the average of all of these, you kind of add up the 544, you add up the 215,000, you add up the 96, and you divide by total revenue, the average is actually going to be a little bit less than this $600. And so, the tiers would be, one standard deviation from the average is going to be a little different than the 600 because you're kind of, normally you'd only be looking at these kind of one brand at a time. So having it all together, it kind of blurs that the actual line of 20% and what have you. But that's kind of shows you the type of illustration that you would ordinarily be doing one brand at a time. So let's do this for you. The next is you're looking at the number of subscribers and the pricing. We'll go right to the paid level. The paid is where that bottom 80% of your subscribers are. These are the fuel of your business, and generating new subscribers is the key to feeding the high value and ultra high value tiers. And so the high value is kind of that next 16% that then is funding your business, and then finally the top 4% are the ultra high value. And the way you really want to inform this in terms of pricing is the bottom 80% are really focused on offers that maximize conversion. And this is conversion rate after 90 days. So you can do a free trial or a $1 trial and maximize the number of trial subscribers that you generate. That's great. But really where I want you to measure your finish line, maximize the conversions, is at day 90 or maybe even at day 120. Which subscription offer maximizes the number of subscribers and the revenue that you're generating at day 90 versus the gross number of subscribers that you are generating at the first conversion day. Because that's really where your cash flow is going to come from, because that first 90 days, depending on the type of offer that you do, you may have a very high churn rate if you give away a bunch of stuff and you give it away for free. If you instead are more conservative and have a little higher threshold in order to get access in, you may very well see that has higher number of new subscribers at day 90 than the free trial does. But regardless, you have to try several different offers, and if this would be useful for us to talk about different offers, we certainly can do that in a future Be Unleavable Subscription Growth program. But today we're really focused on this kind of the strategy behind it. And the strategy is the front end offer maximizes conversion at day 90 and generates the most subscribers at that point, and that's really where your finish line is. Then in terms of pricing, the high value subscription, by default, we play around with this, but I'm usually focused on making the high value priced tier 4 times the price of the paid tier, so that you are 4x, and if it's 3x or 5x, it's probably okay. But usually I'm going, all right, we've created an offer. We've been, it first started out maybe as a minimally viable product. We did some price testing with buyers and saw which price increased the 90-day conversion rate and led to the highest level of actual cash flow. And then based on that, in your next tier, we would price at 4 times the price of that high conversion paid offer. And then at the ultra high value, we're going to price that at 16 times the maximum conversion offer in order to maximize that curve. And that's what's really going to give us this curve here, where you're able to maximize the value of your subscribers. And by focusing on monetization of those 2 tiers, the high value and ultra high value, we're going to be able to really increase the size and value of your customers, that average lifetime value, far faster than we could if we are simply trying to do incremental improvements on your value. So on that average, okay, we're going to try to keep I've seen and been in meetings where I've had, clients tell me that, we have a goal of increasing our average lifetime of our subscribers from 12 months to 14 months. And that's fine as far as it goes, but it's much easier to instead focus on the tiers and instead focus on the first. Of course, most of your the mistake by focusing on 12 months and extending it to 14 is that most of the time they are looking at that 12th month. Like, okay, well, we have an 8% churn rate. An 8% churn rate means that our average customer lasts for 12 months. And so now we want to lower our churn rate so that the average customer lasts 14 months. Let's look at month 12 and see if we can keep our subscribers to month 14. We're going to give them something special. We're going to, and this is the example is a monthly subscription. We're going to do something at month 12. Well, what happens though is if you actually look at the churn rates, you'll see that the actual highest level of churn is in the first 90 days. And that if you focus on month 12, you're actually only talking to a relatively small percentage of the subscribers, and you're going to have a very small impact. You can have a much bigger impact if you focus on the first 90 days and have a 100-day communication plan that improves retention in the first 90 days. That's going to have a much faster, much larger impact on the average. So by focusing on sectors of your subscribers, groups, cohorts of your subscribers, you can have a much higher impact on that average than you can on the average overall itself. So this is on monetization, looking at LTV. This is how you can have a much higher impact on that average LTV, is by having these offers. The core price is focused on cash flow. The next tier, that's kind of that 16% level of the 80-20, is a 4x, and then the top 4% is 16x. And what you want to do is kind of graph your LTV, not only the average, but the actual, kind of sort your subscribers in order by their lifetime value, and then chart, kind of graph and see if you've got an 80-20 curve, or you've got something that's flatter, or you've got kind of something that's weighted too heavily to, to the back end higher price products, and that tells you you're not generating enough new subscribers. So you want to create that graph in order to diagnose and see where you are. Let me show you a little bit of the impact of this with actual subscriber numbers. And so here is an example of an actual subscription business where their average customer value for only the subscription is $544.68. So they've maximized their paid tier, and actually in this example, their paid tier, that level is at $49 a month. And that's what new subscribers pay. Now they also offer other additional products and services that subscribers are able to benefit from, but the total value of the subscription itself is $544.68. So that kind of tells you that on average they're keeping their subscribers around about 10 months. Because it's $49 a month, maybe it's 11 months there, just on average. The high value subscribers are paying $199 a month, and so it's kind of that 4x, and they have a value of $4,901. Notice how it's, even though the price is 4x, the lifetime value is far higher than just 4 times, and that's very common. That when you have and that's why focusing on this tiers can have such a much bigger impact on the average LTV, because that exponential impact of that 80-20, that 4x can actually have a 10x improvement in the LTV. So now this is the subscription only. What happens with the other products and services that they buy is even more, even more impressive. So of the subscribers who are at the paid tier, paying $49, they have an average lifetime value of all the products they're buying of $2,277. And again, this is an actual subscription service, a long-time client of mine. And I could have picked like a dozen of other examples, but I just wanted to show you this one illustration. In this case, a $49 a month subscription. The other products and services that they buy are valued at $2,277. Now, if you look at the other that are $199, their actual value is $29,300.99. It's a massive multiple, far greater than 10 times the value of those subscribers in other products and services that they are buying. This monetization has a tremendous impact on your ability to do additional customer acquisition. If you are only having that $49 level and your customers are generating $2,277, you don't have anywhere near as much money to invest in marketing and customer acquisition cost as if when you add this tier and 16% of your customers now become worth $29,000, that has a massive positive impact on the customer acquisition cost that you're able to invest in generating new subscribers. If this video is helpful to you, if you've learned anything, if it's piqued your interest, please subscribe to the channel and like this show. If you would like some more information, I actually have a free video series that it's 3 different videos that offers training on exactly increasing lifetime value. It's called 10xmembershiprevenue.com, and there are 3 videos there that will walk you through these ideas in pricing, and what I just showed you is something I call whale hunting, and you'll see that the impact that can have, and it really illustrates how you can have a 10 times impact on your subscription revenue by managing some of the other key factors that can have an impact on your business. I'd love to hear your comments on this video and what you thought of how this works. Whatever other questions that you might have, feel free to post those in the comments under this video. And absolutely happy and look forward to seeing you on the next episode of Be Unleavable Subscription Growth.